Most traders believe the market is where money is made. That belief is the first mistake. Money is not made in the market. Money is kept through risk management. The market is simply a mechanism, a machine that transfers capital from the undisciplined to the disciplined. And the only thing standing between you and becoming part of the losing majority is how you relate to risk. Before you ever talk about entries, liquidity, or timing, you must understand this. Every trade you place is a business decision under uncertainty. And uncertainty does not reward hope. It rewards structure. This is where the first law of risk management lives, even though most traders never recognize it as a law. The first law is simple, but brutal in its honesty. You are not paid for being right. You are paid for managing downside. Most traders build their identity around prediction. They want to call tops. They want to catch bottoms. They want the ego satisfaction of being right while the market moves. But the market does not pay for accuracy. It pays for survival. A trader who is right 40% of the time can outperform a trader who is right 70% of the time. If the first trader understands risk and the second does not, this is not theory, this is fact. And once you accept this, your entire relationship with trading changes. Risk management is not a defensive tool. It is an offensive weapon. It determines how long you stay in the game. And staying in the game is the only edge that compounds. This leads us into the second law, which most traders hear but never internalize. Risk must be predefined before the trade exists. If you do not know how much you are willing to lose before you enter, you are not trading. You are gambling with a chart on the screen. Professional traders define risk first, then look for opportunity. Retail traders look for opportunity first, then emotionally negotiate risk after entry. That difference alone separates amateurs from professionals. When risk is not defined, emotions fill the gap. Fear begins to whisper, hope begins to argue, and discipline quietly leaves the room. The market does not care about your emotions, but it will exploit them relentlessly. Predefined risk does something powerful to the mind. It removes surprise. And surprise is what destroys traders. Not losses. Losses are normal. Unexpected losses are what cause emotional damage. When you know the worst case scenario before entry, your nervous system remains calm. You are no longer reacting. You are executing. And execution is everything. Now understand this carefully. Risk is not defined by lot size alone. Risk is defined by the distance between entry and invalidation. Your stop loss is not a random number. It is the price level that proves your idea wrong. When that level is violated, the trade is no longer valid. Staying in after that point is no longer trading. It is denial, which brings us to the third law. A stop loss is not protection. It is an admission of uncertainty. This is where ego gets involved. Many traders avoid stop losses because they believe it means they are weak or unsure or lacking confidence. In reality, the opposite is true. The most confident traders are the ones who accept that they can be wrong at any time. Confidence is not believing you are right. Confidence is knowing you will survive if you are wrong. The stop loss is not there to save money. It is there to save your mindset. Because once your mindset breaks, your strategy no longer matters. A trader without a stop loss is a trader who believes the market owes them something, and the market punishes entitlement faster than ignorance. Losses taken correctly do not hurt. Losses avoided incorrectly destroy accounts. Now, let's talk about the fourth law, one that most traders violate daily without realizing it. Risk must be consistent across trades. This is where discipline shows up, not in your entries, not in your analysis, but in how you size your exposure. When you increase risk emotionally and decrease risk fearfully, you are no longer following a system. You are following your mood, and moods do not compound. Consistency in risk creates consistency in results. Not wins, results. Professional traders think in series, not individual outcomes. One trade means nothing. 10 trades mean very little. 100 trades begin to reveal truth, but that truth can only be measured if risk is constant. If one loss costs you 1% and another costs you 7%, your data becomes useless. Your performance becomes distorted. You begin blaming the market when the real issue is inconsistency. Risk consistency allows probability to work in your favor. Without it, probability becomes noise. This leads naturally into the fifth law. which is uncomfortable for many traders to hear. Your account size determines your strategy, not your ambition. Many traders attempt to trade a large account strategy with a small account. They want big returns without respecting mathematical reality. This is not confidence. This is impatience disguised as belief. Every account size has a ceiling of safe aggression. Exceed that ceiling, and you introduce volatility into your equity curve that has nothing to do with the market and everything to do with your psychology. When drawdowns become emotionally painful, discipline collapses. You hesitate. You revenge trade. You deviate. And the system you trusted suddenly feels broken. It was never broken. Your risk was a trader who respects their account size, trades smaller than their ego wants to, and that restraint is what allows growth. The market rewards patience with opportunity. It punishes impatience with lessons. And here is the final law we will cover in this chapter, one that quietly governs all others. Risk management is a daily habit, not a rule you remember under pressure. Under stress, you do not rise to your strategy. You fall to your habits. If you only think about risk when you are about to enter a trade, it is already too late. Risk management is decided before the trading session begins. It is embedded into your routine, your position sizing, your journal, your expectations. Professional traders are boring. They do the same thing every day. Same risk, same execution, same process. The excitement that retail traders chase is the very thing professionals avoid, because excitement is emotional volatility, and emotional volatility leads to financial volatility. Risk fix that, and everything else becomes easier to see.